Welcome back to the deep dive. This is where we really try to cut through the noise, the complex financial stuff, and give you the essential insights. Today, we're literally analyzing the bedrock of the U.S. economy.
That's a good way to put it.
We're doing a deep dive into construction aggregates. That's the crushed stone, the sand, the gravel, basically the foundation for, everything being built. Roads, skyscrapers, those huge data centers.
Yep.
And our case study is Marietta Materials, ticker MLM.
Right.
They're a huge force in what turns out to be a surprisingly high-margin, high-barrier industry.
That's right. Aggregates.
Yeah.
They often just go unnoticed, don't they?
Yeah.
But they are this massive foundational input. You just can't do without them for economic activity.
Yeah.
We've gone through a pretty big stack of investment research on MLM.
Right.
And our mission today really is to show you not just where the company operates, but how its strategy, its recent strategic pivot, and its competitive advantages position it. Position it really well to capture this huge spending cycle that's happening right now.
Yeah.
We need to understand these dynamics, especially this big gap, this chasm, opening up between public and private construction demand.
Let's start with the scale then, because this isn't some small niche market we're talking about.
Not at all.
Globally, the construction aggregate market, it's valued somewhere between, $375 billion and maybe almost $445 billion. Huge number.
Yeah, massive.
But here in the U.S., where MLM mostly operates, we're talking about an estimated $39 billion market. That's just quarry site revenues. It's local, but, nationally, it adds up to something giant.
And the outlook, the consensus outlook, is remarkably stable. That's a really key factor if you're an investor looking for durability.
Stability is good.
Forecasts consistently point towards, let's say, mid-single-digit expansion over the next decade. We're talking a compound annual growth rate, a CAGR, somewhere in the 4.9% to maybe 6.1% range, right through the early 2030s.
Okay, so not exactly tech stock growth figures.
No, definitely not. But it is steady. It's essential. And it's actually highly predictable growth, driven by demographics, by policy, things you can really track.
Okay, let's unpack that growth, because the market right now, it's not all moving in the same direction, is it?
No, it's not.
It feels defined by what you called the great demand divergence. Different economic sectors seem to be pulling this aggregates market in, opposite directions.
That phrase really does capture it perfectly, because aggregate demand, it's fundamentally tied to three main end markets. And right now, they're performing wildly out of sync. It's quite striking.
Okay, walk us through those three pillars. What are they?
Okay, first, you have infrastructure.
Yeah.
This is the big one. Public works, federal and state roads, bridges, transit projects, airports. This segment is the single largest consumer, uses the most aggregates per dollar spent, accounts for over half of total demand.
Right, the heavy stuff.
Exactly. Second, there's residential construction. This is driven by new housing starts, home building activity, pretty straightforward.
Yeah.
And third, non-residential construction. This covers, everything else. Commercial offices, schools, big industrial factories, data centers. So it was a pretty broad category.
And the paradox, the divergence right now, is this really strong public sector spending.
You wrote books.
Having to basically prop things up against significant weakness on the private side, the side that's really sensitive to interest rates.
That's exactly it.
Let's start with that main headwind then. Residential construction.
Right. Residential construction.
Yeah.
It's faced some real softness, almost entirely down to the Fed's aggressive rate hikes, right? Pushing mortgage costs up to levels we haven't seen in, 2 decades?
Yeah, that hits hard.
It does. And aggregates demand is super sensitive to housing cycles. Every new subdivision, every new housing development needs tons and tons of crushed stone for foundations, roads, utilities, all the surrounding infrastructure.
So how visible is this pain? Can we see it in the actual volume data?
Oh, yeah. It's stark. Crushed stone consumption, that's the industry staple. It fell by something like 3% to 5% across 2023 and into 2024.
Right.
Sand and gravel, which you often use for asphalt and concrete mixing, saw even sharper drops, down maybe 7% to 8%.
Wow.
And we even saw recent figures, I think it was March 2025, showing new home construction dropped 11.4% month over month. That tells you projects were really being deferred, maybe even canceled.
Okay, that's a serious volume problem then. So how does a company like Martin Marietta navigate that kind of decline without seeing its revenue just crater?
This is where that countercyclical strength, the public sector strength, becomes absolutely critical. It's the essential tailwind.
Right.
Infrastructure projects, funded by durable government spending, they act as the buffer. Producers like MLM, who have high exposure to the public sector, have seen that stability really offset the residential slowdown. Honestly, if the industry relied purely on private construction right now, we'd be talking about some severe profitability issues across the board.
Okay. And non-residential construction. That's sort of the wild card. You mentioned softness in, like, light commercial buildings, smaller retail centers and things. That makes sense with interest rates.
It does.
But that's being counterbalanced by these huge capital-intensive projects. Is that right?
Precisely. We're seeing these big secular growth trends that just require colossal amounts of concrete and therefore aggregates. Think specifically about, say, 3 areas.
Okay.
First, data centers. These things need huge, flat, heavily reinforced concrete pads, sometimes miles in size. Massive aggregate consumers.
Right. The cloud needs a physical footprint.
It really does. Second, manufacturing onshoring. These large-scale semiconductor plants, battery factories, EV assembly plants, often pushed by government incentives. They're going up, and they require multi-year construction timelines, chewing through aggregates.
Makes sense.
And third, energy-related builds. Things like natural gas facilities, chemical plants, maybe even nuclear power facility construction. These are foundational heavy-use aggregate consumers. So these specific segments, they're providing really significant geographically focused pockets of strength that are propping up the industrial demand side.
Okay, this is where it gets, for me, really interesting and kind of counterintuitive. It's what sets this industry apart. The pricing secret.
Yeah.
Despite volumes dropping in 23 and 24, because of that private sector weakness, the industry didn't panic. They showed this remarkable, sustained pricing power.
This is the core competitive advantage.
Yeah.
We really need to understand the mechanics here. The strategy is famously known as price over volume.
Price over volume.
Look at the numbers. U.S. aggregate prices rose by an astounding 38% between 2020 and 2024. Just think about that.
38%.
For context, overall U.S. consumer inflation, the CPI number we all hear about, was only 20% over that same period.
Okay, so their prices went up almost double the rate of overall inflation. How? When contractors know residential demand is down, how can these producers successfully push through such steep price increases?
It reflects 2 key things. First, it points to a rational market structure. There's been consolidation among the top producers. They're disciplined. But number 2, and most importantly, it's that intensely local competitive moat.
The local moat.
When we talk about the 70-mile rule, we're really talking about geographic leverage. Aggregates are low value compared to their weight. They're heavy.
Right.
So if a contractor in, say, Dallas needs crushed stone, they have to buy it from a quarry within roughly a 70-mile radius. Because shipping it 100 miles adds so much in diesel costs and transport time, it just wipes out any potential savings from a slightly cheaper price further away.
So if Martin Marietta, or maybe Vulcan Materials, owns the closest quarry to a big, growing city, they effectively have a kind of local monopoly power, regardless of short-term volume dip.
Exactly. That's the key. The contractor might be doing fewer jobs overall. Maybe their volume is down 5%. But for the jobs they do get, they are pretty much compelled to accept the producer's price increase because the alternative, hauling stone from some distant quarry, is even more expensive. This pricing discipline allows producers to push through price hikes that more than cover their own rising costs. Diesel, labor, maintenance, and absorb those lower private volumes. This lets them maintain and often even expand their margins through economic cycles. That stability is why investors find this sector so attractive.
That stability, that pricing power, it leads us straight to the main reason the public sector is so strong right now. The Infrastructure Investment and Jobs Act, the IIJA.
The IIJA, yeah. Signed into law back in November 2021. This is the foundational catalyst. It defines the industry's long-term demand visibility like nothing else right now. It authorized a truly staggering amount, $1.2 trillion in total spending, with $550 billion of that marked as new federal investment spread over 8 years.
And the aggregates industry is just perfectly positioned to catch a huge chunk of that money, right?
Absolutely. The way the legislation is written, it's highly targeted towards things that consume a lot of aggregates. About 52% of that new funding, around $284 billion, is directed specifically toward roadway, highway, and transportation spending.
And that's the most aggregates-intensive category there is.
By far.
We're talking specific earmarked funds too, aren't we? Like $110 billion just for roads and bridges, and another $40 billion solely for bridge repair and replacement. That sounds like it should be an immediate flood of demand.
It is a flood, yes. But here's where we need to be careful about the timing. Because it's a durational catalyst, not an immediate bang.
Okay, durational, meaning?
Meaning there's a significant time lag built in. The money goes from the federal authorization Then it has to get into state-level Department of Transportation budgets, DOT budgets.
Right.
Then projects need engineering and design work. And finally, you get to the letting cycle. That's when contracts are actually awarded to construction firms. The whole process, from authorization to actual demand for stone and gravel on the ground, can easily take 18 to 36 months.
Okay. And that explains why the peak impact, the biggest surge in demand, is actually still ahead of us.
That's the key consensus across the industry. You hear it from all the management teams. As of early 2025, they estimate only about a third, maybe a bit more, of the funds authorized have actually been reimbursed and consumed.
Only a third.
Yeah. So the peak impact on aggregates consumption, it's projected to really arrive across 2025, intensify into 2026, and probably persist well into 2028, maybe even beyond. This long demand tail, this visibility, it's pretty unprecedented.
Yeah.
It helps companies like MLM plan their capital spending years out.
But this huge wave of sustained demand, it can't be without challenges, right?
Yeah.
What sort of second-order effects is all this government spending creating for the construction industry as a whole?
Well, the primary bottleneck, the number one headache you hear about is labor.
Skilled labor.
Or skilled labor, exactly. This government-fueled demand surge is hitting right when there was already a pre-existing, really acute shortage of skilled construction workers.
Yeah.
Heavy equipment operators, truckers, specialized tradespeople. Contractors consistently cite labor availability and cost as their top challenge. And that, slows down how quickly projects can actually get done.
And cost inflation must be another factor, even if the producers themselves have great pricing power.
It is. Definitely. Sustained demand puts constant upward pressure on input costs. We're talking diesel fuel for those massive hauling trucks and equipment.
Fuel's a big one.
Huge. Labor costs, obviously, to attract and keep those skilled workers. And the cost of capital equipment itself. Excavators, crushers, loaders, that's gone up too. So it means producers have to maintain that really aggressive price over volume discipline just to make sure their higher revenues actually translate into better margins, not just get eaten up by costs. It's a constant operational balancing act.
Okay, so the demand picture is pretty clear, pretty strong, especially looking forward. But actually turning that demand into profit relies entirely on operational execution and, crucially, market positioning.
Exactly.
Which brings us directly to Martin Marietta's competitive position and its structural moat.
All right, MLM. It's a blue-chip S&P 500 company. It's one of the sort of big three titans of the U.S. aggregates market. Alongside Vulcan Materials, VMC, and the international giant CRHP plc, the scale is impressive. They operate something like 390 quarries, mines, and distribution yards spread across 28 states.
And their geographic footprint, looking at the map, it seems extremely strategic, heavily concentrated in the high-growth Sunbelt region.
Exactly. That's not by accident. Their core revenue states, think Texas, Colorado, North Carolina, Iowa, Georgia, these are all places seeing massive demographic shifts, population growth, and industrial expansion.
So they put their quarries where the action is.
Precisely. This strategic location, having their assets near the fastest-growing metropolitan areas, that is their most durable competitive advantage. Remember that 70-mile rule we talked about? They've successfully positioned these, frankly, irreplaceable assets right where the growth is happening, maximizing their leverage.
Let's dig into that word, irreplaceable. Why is this asset network considered so hard to replicate? Why can't some competitor with deep pockets just decide to open a new quarry, say, 50 miles outside Houston or Atlanta?
The barriers to entry are just. They're formidable. They span regulatory hurdles, social opposition, and massive financial requirements.
Okay.
Just establishing the new quarry, what's they call a greenfield site, is easily a multi-year process. Often it can stretch into multi-decade endeavors.
Decades. Wow.
Yeah. You face incredibly stringent environmental regulations, permitting is complex, then you have restrictive zoning laws, and often you run into the NBY factor, not in my backyard, from neighboring communities who don't want a quarry nearby.
Understandable, I guess.
And on top of all that, you need massive upfront capital investment for the land itself, for the crushing equipment, for reclamation bonds. It's a huge financial lift.
So all those hurdles effectively create this protective barrier around existing permitted operations, like MLM's network.
Exactly. Because new quarries are so incredibly difficult to permit and develop near the major metropolitan centers where demand is highest, MLM's existing network, which they've built up largely through generations of smart acquisitions, functions almost like a series of local monopolies. It protects their pricing power and their market share.
And this also ties into their long-term resource security, right, their reserves.
Absolutely critical point. MLM controls this vast, permitted mineral reserve base. The estimates suggest it's sufficient for over 85 years of production, just at their current operating levels.
85 years.
Think about that strategically. As cities keep expanding outward, high-quality permitted aggregate reserves near those urban centers become increasingly scarce, and therefore exponentially more valuable. That 85-year reserve life isn't just an operational number, it's a huge strategic asset. It provides long-term operational certainty that smaller players just can't match.
Okay, so when we look at how they stack up against competitors, the proof should be in the profitability numbers.
It should be.
You mentioned Martin Marietta's 2024 adjusted EBITDA margin was 31.6%. Can you just remind us what adjusted EBIT margin tells us?
Sure. Adjusted EBITDA margin, that's earnings before interest, taxes, depreciation, and amortization, with some adjustments, is the standard way to measure a company's core operating profitability. Before you factor in financing costs or big capital expenses like depreciation, basically it tells you how efficiently they turn a dollar of revenue into operating profit.
Got it. And MLM's was 31.6%. How does that compare to, say, Vulcan Materials, their closest U.S. peer?
Right. Compare MLM's 31.6% to VMC's 27.7% in 2024.
Okay, 31.6 versus 27.7. That's almost a 400 basis point difference, nearly 4 percentage points. That seems like a really big gap in profitability for what's essentially a commodity business.
It is a huge margin gap, and it's hard evidence of best-in-class operational execution by Martin Marietta.
So what drives that? Why are they more profitable?
It reflects a combination of things. Superior cost control, probably better procurement practices, maybe more efficient operations, but also, crucially, more favorable geographic mix. Being concentrated in those high-growth Sunbelt regions where demand is strong allows them to command the highest prices. It really validates their strategic discipline and clearly positions them as the premium operator, at least in terms of margin profile.
And that superior profitability, as you said, doesn't happen by accident. It's driven by a deliberate strategy. Let's talk about the specific playbook that seems to guide all their investment and operational decisions, this SR framework.
Ah, yes, SOR, the Strategic Operating Analysis and Review. This is really the engine behind Martin Marietta's long-term success story. It's a highly disciplined, long-term planning framework. They refresh it every 5 years or so, and it dictates everything from capital deployment priorities to their commercial strategies on the ground.
And it's a proven playbook.
Seems to be. Management loves to point out, and it's true, that the company's market capitalization actually doubled in value during each of the last 3 5-year SOR periods.
Doubled each time. Okay, that's impressive consistency. What are the core principles, the tenets embedded within SR?
The SOR framework mandates 2 really key operational priorities. First, the strategic focus must always remain on the aggregates-led business. That's the core, the one with the high barriers to entry and the superior pricing power we've been talking about. It explicitly guides capital away from businesses that might dilute that high margin profile.
Stay focused on the best part of the business.
Exactly. Second, the commercial strategy is relentlessly focused on value over volume. This is more than just a slogan for them. It dictates how their sales teams approach pricing negotiations. They prioritize margin expansion, even if it sometimes means walking away from lower margin sales volume. It also dictates their criteria for M&A. They only pursue acquisitions that are close to their existing Sunbelt network and that enhance their local market dominance and pricing power.
Okay, and the most dramatic, most recent execution of this SR mandate has been this massive portfolio cleanup they did throughout 2024 and into 2025. This looked like a really decisive pivot away from being vertically integrated.
It was a genuine transformation,
Yeah.
a really big strategic shift. The goal was crystal clear. Get out of the more volatile, lower margin, and frankly, highly capital-intensive cement and ready-mix concrete businesses.
Right.
And then redeploy that capital back into the pure play, higher margin, higher barrier aggregate sector. They are actively streamlining their earnings profile to focus on quality.
Let's walk through those landmark deals because they really do tell a cohesive story when you line them up.
Okay. It started with reinforcing the core aggregates business. They did 2 major acquisitions, Albert Free & Sons out in Colorado, and then 20 aggregates operations they bought from BWI Southeast. Together, that was about $2.05 billion spent.
So strengthening the core first.
Strengthening the core,
Right.
deepening their competitive moat in key Sunbelt markets immediately. Then came the strategic exits, the divestitures.
Right, the huge cash deal.
Exactly. The landmark deal was selling their South Texas cement and related concrete operations to CRH for a massive $2.1 billion cash payout.
$2.1 billion cash.
Cash. And the key rationale here wasn't just getting the maximum cash price, it was strategically exiting a business cement that's known for being cyclical and requiring huge amounts of capital. And specifically, exiting a geographical area, South Texas, that wasn't perfectly contiguous with their core Sunbelt focus. So maximizing the value of what they considered non-core assets.
Okay, makes sense. And right after that huge sale, they did that asset exchange with Quikrete?
That was the final piece of the puzzle, the final step in this purification process. They divested their remaining cement plant and their North Texas ready-mix concrete assets. But instead of just selling for cash, they traded those, let's call them volatile, lower-margin manufacturing and distribution assets for two things they value more. One, 20 million tons of highly defensible, long-life aggregates reserves and capacity right in their core North Texas market. And two, another $450 million in cash on top.
Okay, so they essentially sold the high-volume, capital-hungry manufacturing and distribution businesses, the cement and ready-mix concrete plants,
Yeah.
to basically become a pure-play, high-margin quarry owner and operator. They traded that volatility and capital intensity for resilience and margin superiority. Is that a fair summary?
That's a perfect summation of the strategic rationale.
Yeah.
They are intentionally reshaping their entire earnings profile, making it more resilient against any private sector downturns and maximizing their leverage to that huge IIJA spending cycle. It aligns perfectly with the SR philosophy we discussed.
All right, now let's pivot to the financial strength you need to actually execute these kinds of massive multi-billion-dollar strategic moves. Looking at their revenue trajectory, they had pretty consistent growth leading up to a record $6.78 billion in 2023.
That's right. And the slight dip you see in 2024, down to $6.54 billion, needs context. That wasn't operational weakness. That was a planned outcome, directly resulting from selling off those cement operations we just talked about.
Right, selling revenue-generating assets.
Exactly. Crucially, the underlying aggregates business, the part they kept and are focusing on, remains robust and growing. And that's the segment the market now values most highly anyway.
Okay. And if there's one single metric that you think listeners should monitor to really gauge the operational health of that core aggregates business, what would it be?
For me, it's aggregates gross profit per ton, hands down. This is the ultimate indicator of their unit profitability. How much actual profit are they squeezing out of every single ton of stone they sell?
And how's that metric looking?
It's looking strong. In 2024, that metric increased by a healthy 9%, hitting $7.58 per ton. That consistent compounding, even with those short-term volume headwinds in residential, that really validates the success of their price over volume strategy and their relentless focus on creating value per unit.
Okay, we see strong cash flow generation too, about $1.46 billion in cash from operations in 2024. But their capital expenditures, their CapEx, seems to be rising significantly, guided up to, what, $725 million to $775 million for 2025. Does that rise in CapEx signal an issue with inflation, or is it something else?
It signals both, actually. But primarily, I think it signals managerial confidence. Yes, part of that increase definitely reflects inflationary pressures on heavy equipment parts, things like that.
Sure.
But more importantly, it signals strong, forward-looking investment. They're consciously deploying capital now to ensure they have the capacity to meet the anticipated surge in demand from the IIJA spending and continued Sunbelt growth, especially looking out to 2026 and beyond. A classic example is the huge modernization project they're doing at their Bridgeport Chico facility in North Texas. That's actually the company's second largest capital project ever undertaken. They're investing heavily there to secure long-term capacity, specifically for the booming Dallas-Fort Worth Metroplex. It's a bet on future growth.
And that disciplined approach seems to extend to shareholder returns as well.
Absolutely. They're quite proud of their record here. They boast 10 consecutive years now of annual dividend growth. The current annualized rate is $3.32 per share.
10 years running.
And importantly, the payout ratio remains quite low, only around 17% to 18% of earnings. That provides a significant safety cushion for that dividend commitment. And it also leaves plenty of capacity for future dividend increases or potential share repurchases down the line.
And crucially, they're managing all this, the strategic transformation, the growth investment, the shareholder returns, while maintaining a really solid balance sheet.
Yeah, this is key for investor confidence. They hold a highly sought-after investment-grade credit rating. It's BBB plus from S&P and Ba1 from Moody's. And they maintain pretty prudent leverage. Their net debt to adjusted EBITDA ratio is running around 2.3x.
Can you quickly explain what net debt to adjusted EBITDA tells us?
Sure. It's a standard leverage metric. It basically measures how many years of its current operating profit, adjusted EBITDA, it would take for the company to pay off all its debt, net of cash. A ratio of 2.3x is generally considered conservative, especially for a stable cash flow business like this. And that conservative leverage provides tremendous financial flexibility. It allows them to simultaneously fund their organic growth projects, execute these big transformative M&A deals like the ones we discussed, and return capital to shareholders through dividends, all without straining the balance sheet or risking their credit rating.
Okay, now we really have to address the elephant in the room. The thing that makes a lot of analysts pause, the valuation. Martin Marietta stock trades at a significant premium compared to its own historical metrics.
It does. That's definitely true and worth discussing. The trailing 12-month price-to-earnings ratio, the TTM-PE, that's the current stock price divided by the last year's earnings per share, it stands somewhere around 34 to 35 times earnings.
34, 35 times.
Yeah. And another common metric for capital-intensive companies like this is enterprise value to EBITDA. That's running around 20 times. Both of those figures are well above MLM's historical average PE over the last 5 or 10 years,
Yeah.
which was closer to, say, 26.5x.
Right. So a lot of analysts look at that 34x PE and think it's just unsustainable. Is there a real risk here that all the good news, especially the IIJA tailwind, is already completely baked into the stock price, leaving very little upside for new investors? What's the market's justification for giving it such a high valuation multiple?
Look, the market's justification, or rationalization, depending on your view, is entirely forward-looking, and it's rooted in the perceived quality of this specific business. The high valuation is essentially the market pricing in two massive factors. First, the full sustained benefit of that prolonged IIJ spending cycle, which, as we've discussed, likely still has its peak years ahead of it in 2026 and beyond.
Okay, pricing in the future demand.
Right. And second, and this might be even more important for the multiple expansion, the market is recognizing and rewarding the successful strategic pivot. The move to become a higher margin, more focused, pure-play aggregates company.
So the bet is that this purification strategy will lead to permanently higher and maybe more resilient profit margins than the company achieved historically when it was more diversified.
Precisely. The market seems to view MLM, and probably Vulcan Materials too, as the premier sort of blue chip ways to invest directly in these powerful secular themes. U.S. infrastructure renewal and continued Sunbelt population growth. Investors appear willing to pay that premium valuation for the perceived quality, for the superior margin profile they're demonstrating now, and for that unusual long-term demand visibility provided by the IIJA funds.
But high expectations always carry high risk. Let's explore the bear case. What are the key risks that could potentially derail this bullish thesis and maybe justify a lower valuation?
Well, the number one risk, it always comes back to this, is macroeconomic cyclicality. At the end of the day, this business is fundamentally tied to the health of the overall construction sector.
Right.
If we were to see a sharp, unexpected recession that really hit non-residential industrial activity hard and maybe prolonged the current residential slump even further, then private sector volumes could be severely impacted. Even robust federal spending from the IIJA might not be enough to completely offset a deep national downturn across all sectors.
And related to that, I suppose, is political and budgetary uncertainty, even with the IIJA supposedly locked in.
Correct. While the IIJA is passed legislation, there's always the background risk of future changes, maybe reductions or delays in federal or even state-level infrastructure spending down the road, perhaps driven by future budget pressures or, political shifts in subsequent administrations or Congresses. Nothing is ever truly guaranteed in perpetuity. Furthermore, input cost volatility remains a persistent concern. We talked about their high exposure to diesel fuel and labor costs. Margins are always potentially vulnerable if their pricing power, that incredible 38% price growth we saw, were to suddenly slip or decelerate much faster than expected.
And internally, they've just swallowed some big acquisitions. There must be execution risk there, integrating those new businesses.
That integration risk is definitely significant, especially given the scale of the 2024-2025 deals. Failure to integrate those new businesses, Albert Frey, the BWI operations smoothly, or failure to achieve the cost savings and synergies they expect, that could certainly damage financial performance and shake investor confidence. And finally, there's the ongoing challenge of permitting risk. We touched on it earlier. Securing new quarry permits near rapidly growing communities is just getting harder and harder. Due to increasing local opposition, zoning challenges, this could potentially constrain their future reserve replacement and limit their ability to efficiently serve new demand centers as they emerge.
Okay, so for our listeners who are maybe watching this sector, or MLM specifically, what are the two or three most critical metrics they should keep their eyes on to see if Martin Marietta is actually executing effectively and continuing to justify that premium valuation?
I'd say you absolutely have to watch the pricing levers, first and foremost. So number one, monitor the aggregate's average selling price, the ASP. You need to see continued upward momentum there, or at least stability at high levels. If that ASP starts to decelerate sharply, the whole margin expansion thesis comes under immediate pressure.
Okay, watch ASP. What else?
Second, keep a laser focus on that aggregate's gross profit per ton metric we discussed. That's the ultimate scorecard. It must continue its consistent upward trend, ideally growing faster than the rate of underlying cost inflation. That proves the value creation is real.
Got it. ASP and gross profit per ton. Anything else?
And finally, I'd keep a keen eye on the leading indicators for public construction activity. Specifically, watch State Department of Transportation budgets, are they growing? And watch the pace of project letting announcements, are contracts actually being awarded? That's your best real-time indicator for whether that IIJA tailwind is truly translating into physical aggregates consumption on the ground.
This has been an incredibly detailed deep dive, thank you, into a sector that, as you said, really operates beneath the surface most of the time, yet it fundamentally determines the speed and direction of so much economic growth. Martin Marietta seems strategically focused, leveraging these huge trends demographics in the Sun Belt, unprecedented government infrastructure spending. They're using that durable competitive moat, their irreplaceable asset network, and this proven SOR playbook to drive industry-leading margins, especially after that strategic purification.
I think the synthesis is pretty clear, yeah. Martin Marietta has deliberately positioned itself to capture superior profitability, even with the current weakness in the private sector. They've effectively traded some volatility for more resilience and higher margins. But maybe let's leave you, the listener, with one final provocative thought, something that takes us back to that great demand divergence we started with.
Okay, let's hear it.
Right now, the story is clear. Strong public sector spending is successfully offsetting a weak private sector, particularly residential. And management teams across the industry believe the peak IIJA spending is still ahead, maybe 2026 and beyond.
Right.
But what stands out to you when you think about the potential for a soft landing for the broader U.S. economy?
Meaning inflation comes down, rates stabilize or fall without a deep recession.
Exactly. What happens if interest rates do normalize over the next, say, 18 months or so? And that residential market, the currently weak private sector engine, what if it reignites? What if housing starts pick back up meaningfully? If the market achieves that kind of soft landing, you could suddenly move from having just one demand engine, public infrastructure, running at full power, to having both the public engine and the private residential engine firing on all cylinders simultaneously.
Wow. Okay, both running hot at the same time.
That scenario would push the underlying demand for aggregates, for stone, sand, and gravel to levels we probably haven't seen in decades. It would likely generate extraordinary pricing leverage for well-positioned producers like MLM. And that kind of earnings power might further justify or even expand the current premium valuation. That's the ultimate upside scenario to maybe contemplate as you watch those DOT budgets, housing starts, and interest rate movements over the next couple of years